Welcome back to Alpha Recap. Glad you could join us after the close. We've got a lot to unpack from a pretty wild trading day. As always, if you have questions, you can reach us at stockalpha.ai.
Hey everybody, big day. Markets closed mixed after a volatile session on March 5th, and the headlines were loud. So, what really stands out here is the oil shock and how it rippled through everything.
Totally. To set the table quickly, there were reports of a tanker attack in the Middle East that pushed crude above $80 a barrel, and the Dow plunged. It fell about 1,000 points intraday as headline risk spooked investors. That number really jumped out to everyone watching.
Yeah, that tracks.
But it wasn't all red. We actually saw a split tape. Renewables and utilities picked up positive policy and project headlines, materials and mining got some M&A momentum, and pockets of tech and media were buoyed by AI product news.
Right. And the other thing is, crypto was this weirdly bifurcated story. Spot flows into Bitcoin ETFs helped BTC briefly top $73,000, but miners were selling coins fast, and there were some security headlines that kept the group edgy.
Let's walk through the winners first. Utilities and renewables were solid. New Jersey added 3 gigawatts of community solar, battery projects, and virtual power plant initiatives were in the headlines, and even TerraPower's Natrium reactor won NRC approval. That's a lot of de-risking in one day.
Exactly. Those are concrete milestones investors can model. When you get permitting wins and project capacity additions, it changes how you value long-duration cash flows. You're not just buying a story, you're buying contracted or policy-backed revenue.
I mean, when you step back and look at this, utilities with regulated rate bases and storage-capable balance sheets were rewarded, while uncontracted, highly levered developers were a different conversation.
Materials and mining also outperformed on deal activity. Tempest Minerals' Zealandia deal and SSR Mining selling Chopler for about $1.5 billion were big headlines. Combined with renewed focus on critical minerals and recycling, that group had momentum.
Honestly, I was a bit surprised by this one.
Why surprised?
Because while energy was getting hit by the oil spike, investors piled into materials that are actually part of the longer-term energy transition. You get geopolitics on one hand and industrial repositioning on the other.
Right, we basically watched a bifurcation within the energy complex. Traditional oil and gas names were pressured by the spike and headline-driven volatility, while renewables and grid tech kept collecting wins. 2 different risk-reward pathways.
Okay, quick reaction.
Go for it.
Wow, not great.
So let's talk losers. Finance and banking were among the hardest hit, right? The market scare amplified risk aversion. Banks and brokerages felt that immediately, even though some firms got regulatory relief.
Yep. Higher oil can feed into inflation expectations, which complicates the Fed message and consumer costs. That reverberates through credit-sensitive sectors and cyclicals. Not a friendly day for financials generally.
And energy equities were volatile too. Even though there were strong renewable headlines, geopolitics dominated crude. A zero-bid Alaska lease and tanker attack reports tightened supply concerns and pushed near-term volatility higher for oil and gas names. Switching gears. Technology wasn't a uniform story. We saw product-led optimism. Demand at MWC for hardware, AI glass shipments, Amazon refreshing Fire TV, Microsoft teasing Project Helix. That kept some tech names buoyed.
But there were caution flags too. Partnership pullbacks and security or standards concerns cropped up. NVIDIA flagged some partnership changes and platform governance stories came up. So within AI, you really needed to pick names with execution and cash flow certainty.
Short reaction.
Selective is the key word.
Now, let's pull out the cross-sector themes. First, geopolitical risk magnified market correlations. Oil moved and several sectors moved with it, especially financials and cyclicals. Commodity shocks can quicken inflation expectations and compress risk appetite.
Second big theme, that energy bifurcation we mentioned. Short-term oil upside versus long-term renewable acceleration. Investors should treat those as separate plays, not one monolithic energy trade.
Third, AI and hardware continue to anchor rotation within tech and media. Product cadence at trade shows is driving sentiment, but partnership and security issues mean it's a stock picker's market.
Fourth, M&A in materials and strategic repositioning around critical minerals.
That's driving flows towards scale, ESG compliance, and downstream capabilities. And fifth, crypto remains a tug of war. ETFs supporting price discovery versus miners increasing supply by selling coins.
Short reactions, quick affirmations. Right.
Yeah, absolutely.
Let's run through the most significant moves and why they matter. First, the oil spike and the market shakeout. What happened was that tanker attack reports pushed oil above $80 a barrel and triggered that intraday sell-off. Dow down about 1,000 points.
Why it mattered. Beyond the immediate P&L hits, higher crude raises the odds of headline-driven inflation scares, complicates central bank communication, and makes investors more risk-averse. Tactically, traders might use short-duration hedges, while longer-term investors separate tactical oil exposure from strategic renewable allocations.
Second, utilities continued to win on policy and project delivery. New Jersey adding 3 gigawatts of community solar, VPP scaling, and TerraPower's NRC nod were big de-risking events. That supports valuations for regulated utilities and developers with contracted assets.
Materials M&A also matters. Those divestments and deals reprice the sector around security of supply. Firms that can show access to critical minerals, downstream processing, or recycling get investor preference.
And tech, product momentum at events kept appetite for device makers and AI infrastructure people, but you had to weigh that against partnership and security headlines. It's execution that separates winners from the rest.
Crypto again. ETFs took BTC above $73,000 briefly, but miner selling and security/regulatory stories created near-term pressure. So institutional flows are supporting price, but structural noise remains.
Finance. The market plunge hit banks and brokerages hard. Some firms, like the one that got regulatory relief, had idiosyncratic upside, but broadly the space felt the macro hit.
So what should investors actually consider doing? Actionable insights. Number 1. Rotate selectively into utilities and renewable infrastructure, but differentiate by balance sheet strength and contract mix. Favor regulated utilities with contracted pipelines and storage-capable balance sheets.
Number 2. Treat energy as a two-book opportunity. Use short-duration instruments for tactical oil hedges and keep longer-term allocations biased toward renewables and electrification. Don't make a blanket energy call.
Number 3. In tech, focus on execution and cash flow certainty within the AI theme. Favor large-cap platforms and infrastructure names with proven monetization and supply chain resilience.
Number 4. In materials, favor scale and downstream integration. Well-capitalized miners with processing capability and offtake agreements will likely do better than single-asset juniors.
Number 5. In crypto, prefer regulated ETF exposure for core allocation. Miner equities are levered and volatile, so position size them conservatively and monitor selling patterns.
Number 6. For financials and cyclicals, hedge macro commodity exposure. Short-duration put spreads or a defensive tilt into utilities or consumer staples can protect while you wait for stabilization.
Right. Suggested tactical moves in plain terms. Use ETFs and options for short oil exposure. Add regulated renewables with contracted revenue for longer-term exposure. Favor large-cap AI plays with recurring revenue. And size crypto miner positions small, if at all.
Quick reactions. 2 tiny notes. First, liquidity matters in times like this. Keep some dry powder.
Second, double-check counterparty and offtake terms on renewables.
On the watch list for the next 1 to 3 months. Middle East developments and shipping stability headlines. Fed comments and inflation prints. NWC adoption metrics for AI hardware. Renewables permitting milestones, including TerraPower deployment cadence. Bitcoin ETF flows versus miner selling. And materials M&A and critical mineral policy steps.
Yeah, keep an eye on those. They'll drive sector moves more than daily headlines.
Final takeaways before we close. Headline risk can create rapid dislocations. Today proved that. But structural themes remain intact. Renewables, grid tech, and materials with real assets or scale are getting funded and re-rated. AI product cycles are keeping selective tech leaders supported. And crypto's ETF versus miner dynamic will continue to be key.
So what really stands out here is being selective. Tilt into quality within secular winners, keep tactical defenses in place, and position size where volatility and headline risk are high.
Closing checklist. Quick actions you can take today. Reassess energy exposure and hedge or trim high beta energy and financial cyclicals if you can't stomach headline risk. Add to utilities and renewables selectively where contracts and permitting exist. Favor tech names with clear AI monetization paths. And use regulated crypto ETFs for cleaner BTC exposure while keeping minor equities as small tactical bets.
Short and sweet. And if you want us to dig into any of these sectors next episode, say the word.
If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for tuning in. We'll see you next time on Alpha Recap.